Good morning, everybody. It's Trent Klarenbach with Klarenbach Research. Today is September the 12th, 2024, and I want to talk about hedging and the use of the futures market as a risk management tool. Now, the futures market can be a great tool to replace sold grain, for example, or to participate to avoid the downside. You can hedge your long position in your bin and short the futures market in order to participate and make some money on the downside while you're losing it in the bin. So I feel it's often not used effectively, and it's kind of a weird I think it's a weird thing here where hedging, I'm going to put a hedge on, and it sounds like you're really doing something and you're making a astute business decision. But when you're hedging, you have to really consider the direction of the trend. Just like every one of your asset classes, you really want to be aware of the direction of the trend. The best way to do that is to do your trend analysis across multiple time frames. So as a farmer, I suggest being aware of the monthly chart, but more likely the weekly and the daily chart. So you really want to be aware of where the direction of the trend is going. So let me just talk about this for example. So if you are long canola in the bin, and one way to hedge, a proper hedge, you've taken an opposite position to that, you would short the futures market, with puts, or buy a put or sell contracts. So, but if the price is rising, you're losing money on paper, and I don't understand why you would intentionally lose money on paper if you recognize the trend has changed and it's moving higher. Likewise, if you have sold your canola, for example, and or your soybeans, and you would want to replace that, maybe buy a futures contract, buy a call if the price is rising, and participate in the upside in that price. Now, again, it's most important you want to understand where the direction of the trend is going. So in my world, and in the way I look at it, is why lose money on paper as a farmer so you can have a hedge in place as some sort of risk management tool? If you're losing money on paper, if you're hedged against the direction of the trend, for example, you're actually increasing your risk. Anytime you take a trade against, the primary trend, or, in my case, I use the weekly chart as a primary longer-term chart for farmers, or against the daily, you're almost guaranteed to lose money on paper. Now, I don't understand why you would do that. And, it's hard enough to make money, and let alone intentionally lose it. So something that I really struggle with, and I struggle with some of the information out there and some of the advice that's given. So this past week here, I had a buddy call me, and he has a hedge on his diesel. So he had shorted diesel futures, and he had gone long diesel futures, and in anticipation of the price going up, and he would, offset his purchases and his needs with a long position. Now, the challenge that I recognized is, I just looked at the weekly chart here, and this is what I got pulled up here right now. You can see my moving averages here is the 50 and the 200. It doesn't matter if they're what they are. We're below those moving averages, and it's a sign of a downtrend. So my buddy was down 20 cents, and he had a couple contracts, so it's a significant amount of money. And I just wondered, I didn't really understand why that trade would be placed in a downtrend. Why would you trade against the downtrend? So on the weekly chart, it's certainly in a downtrend. It's certainly a cause of concern for me. When I look at the daily chart again, we were below again the green 50-day and the purple 200-day moving average. And really, you don't want to be long below any of those. The price is below both of those that are declining. You really, if you're going to take a long position, it's going to be a short-term scalp, a day trade, or a short-term swing trade. It's really high-risk trades. So he didn't quite understand that. So you want to be really aware of the direction of the trend and how that matches up with your position in the futures market. So if you're going to speculate, you're going to hedge, look at the trend, look at it across multiple time frames. In the case of farmers, I tend to look at the weekly and the daily. I feel the monthly might be a little bit too long for most people, considering, you're growing the crop, or after you harvest the crop, you're selling it in the next 11 or 12 months, right? So I just feel the monthly might be a bit too long. But interestingly enough, so when he's in that position, he asked me what he should do. And really, the idea is to, if you ever enter in a position, whether it's a hedge or speculation, the most important concept to know is where you're getting out if you're wrong, and there's a good chance you're going to be wrong. So, we just look for, okay, now he's in this position. Now what do we do, right? So I'm helping him try to manage this position. I drew a trend line here. We happen to be testing this trend line. Looks like the week's going to close above it, so giving us some chance of a rally. But I mean, I've played this game too often where I haven't managed my risk properly, and then you look for these reasons for the trend to change and to get a rally in the price and it's a horrible feeling. So number one, take your position in the direction of the trend across multiple time frames, the weekly and the daily chart. Number two, have a risk management plan. Identify where you're getting out. If you're wrong, have that level identified before you actually know where you're entering the trade. My name is Trent Klarenbach. It's overcast in Saskatoon. Life's good.